I think a 20% decrease is extreme. I understand the argument that there are certain overvaluations within the tech rally. It has been rather dramatic in the past week. But one thing that we do see when there comes to credit tightening, banks looking at reassessing their deposits and their balance sheets, is that companies with good free cash flow do very well. And those tend to be a lot of technology companies, in particular software services. So I think in this case, just saying it's all about valuations or like recession or slowing growth and that type of thing is missing part of the whole story. And I think there are companies that could still do very well and have seen their bottoms.
All right, so certainly something to watch there, Aaron. I also want to ask you about this production cut by OPEC Plus, increasing the price of gas. We're seeing RBOB, which represents that retail gasoline price, up 3% this morning. WTI, the U.S. benchmark, up 5%. Does this increase in oil prices? Some analysts believe it could get up to $100 a barrel. Does that change your thesis when it comes to portfolio management?
Well, I still think that avoiding energy companies and is a good thing. I think that they're just too volatile, and we've seen most of the gains within them. And certainly, if the oil rather does go back up to 100, we're still seeing we're not going to see skyrocketing increases in profits. So. For the most part, I think I don't think that's going to be such a big impact on the inflation sort of looking forward. Certainly, even by the time we get to the next Fed rate hikes, the oil could come back down because we've essentially got almost a 2-month break here. So not right now. For now, I don't think it's going to be an actual event just yet.
Okay, so you're also watching the financial sector. What's your view when it comes to the U.S. financial sector and also the overseas, including the European financial sector?
Right. So almost two different stories. Now, certainly within the U.S. financial sector, that I think is an area companies are going to be forced to reassess their deposits, reassess their balance sheets, perhaps tighten up on credit. So I think that's a vulnerability that we're going to be seeing within the U.S. Fortunately, within the European banks, they have, in general, across the board, they have much better ratios, deposits. They're much less dependent on deposits and that type of shift. And Deutsche Bank here, after its particular downturn, does look very attractive from a valuation basis and just from their strengths of their balance sheet and their creditworthiness.
All right, Aaron, I want to get to some of your picks. They're Apple, Adobe, and also Chipotle. What's the key factor making, in your mind, these good picks for right now?
So that's all about cash flow to invested capital. So good old cash flow combined with momentum. So these are stocks that have been doing very well in the past 2 weeks, have really, as the markets have turned around since mid-March, and we've seen that rebound. These are some of those companies that are leadership, but also have exceptional strong fundamentals. And I really love those strong free cash flow. There's nothing like companies that have great cash flow when it comes to facing some headwinds from either a slowing economy or rising interest rates.